Hi, I'm Suzanne Gibson from eComply, and this video is specifically aimed at mortgage brokers and more specifically debt consolidation. It is one area that is very topical. The FCA have written large, very large articles on it and consultation papers, etc. And it is something that a lot of firms do struggle with. When you advise somebody on debt consolidation, it must be the right thing for them, and you must get all the information that you actually need to be able to then give the advice. That means making sure that you find out what their income and their expenditure is, to see whether or not are the payments really unaffordable, or do they actually have a large reserve extra each month. I've seen some files where a customer has been advised to debt consolidate and they actually have £1,000 a month left. The reason for their debt consolidation was because they couldn't afford to meet the payments, yet they had £1,000 a month disposable income. When you see things like that, it's often and not the right advice. So please take care when you're looking at somebody who wants to debt consolidation. What are their circumstances? What's their income and what is their expenditure? And do they really need to debt consolidate? You should only ever put debt onto a mortgage if it is the last thing, their last option to do. You should be looking at other alternatives. Is it better for the customer that they put it onto a 0% interest credit card, or they put it onto a personal loan which is on a shorter term, or even maybe take out a second charge on a shorter term so that they're not paying interest for the whole length of the mortgage? These are all different things that you need to be considering when you do debt consolidation. Also as well, what debt do they actually want to consolidate? I've seen a £500 House of Fraser credit card type thing put onto a mortgage. The customer had over £1,500 a month disposable income. When you see something like that, red lights obviously appear. Unfortunately, in that scenario, they hadn't actually completed on the mortgage, and we suggested that they pull back and they don't put that card onto their mortgage, which had about 22 years left to run. So consider the amount of money that they're actually wanting to put onto their mortgage. Also as well, what's the interest rate? If it's a 0% interest free card, we would always suggest don't put it on the mortgage, because you're now taking something that is 0% interest onto something that obviously does produce interest, and it's got a term of 20 odd years or whatever it is. Also as well, consider each debt in isolation. Do they need to add every single bit of that debt or debt that they have? I've seen some scenarios where they've just said they just wanted to put all the debt onto the mortgage so that they've just got one payment. The fact that they've got direct debits and they're not actually having to physically go into the bank to make these payments then sort of counteracts their reasoning, if you like. So find out what their reasons are for each particular debt. Make sure that you get the interest rate, how long has it got left. If it's only a short term, then maybe they can actually make those payments. If they've only got, say, 3 or 6 months payments left, then, and they're making their payments, then hold it out. Also as well, look at whether or not the customer is a repeat credit card loan type person. If they're constantly wanting to just put it onto the mortgage, then it shows a trend that they just think, oh, rack another load of debt up and put it onto the mortgage. It's not the best advice if you're continuing to do that, because at some point the bubble will burst. So have a look, as I said at the beginning, look at all of their circumstances. The reason why you use a fact find is to find out what the customer's circumstances are. Then you advise them on what you think that they should do. Would you put all of that money onto your mortgage? What happens if something like you lost your job or they lost their job? They couldn't make those payments. So just think about everything that you're doing. One of the things that we have produced on our fact find is a section which is specifically for debt consolidation. It reminds advisors that they must look at the alternatives and then advise them accordingly. We've also included a whole section on our advice process manual, which is all about debt consolidation, and these are the things that you and what you should be looking for. So please visit our website if you need to. If it is something that you want to do, or you think that you have customers that you will be in those discussions, now is probably a higher percentage rate with what's going on in our country and around the world. But have a think about it. If you need us, you know where we are, and please visit our website at eComply.